Welcome back to The Pop. Today's guest is Alaoui Zenere. She's the head of financials and fintech equity capital markets at JP Morgan. So this is going to be the investment banking episode. She runs IPOs, follow-on capital raises, and broader capital market advisory work beginning to end. We're going to learn a little bit about that. And most interestingly, she worked on all of the major fintech and crypto IPOs of the last couple of years. Robinhood, Circle, Bullish, Coinbase, et cetera. Deeply experienced investment banker. So Alaoui, thank you for joining us.
Thank you, Robert, for having me.
So first question, how did you become an investment banker?
It's a great question. So I became an investment banker really like the classic route. So I graduated from University Paris-Dauphine in France. I did an internship at JP Morgan in London and really loved my time there. I met a lot of people. I had a lot of experience. I saw all the excitement and hype of being part of the capital markets team, and I really wanted to be part of it. So I started right there. I got hired as an analyst and made my way up all the way to becoming a managing director.
So how many different capital market transactions do you think you've done in your career?
Wow, that's a good question. I think it's in the
ballpark.
200 plus. Yes. From, when I started in debt capital markets doing bond deals all the way up to doing some of the high profile IPOs you mentioned. Yes, hundreds.
So this is a show about IPOs. Let's focus just on this, category of transactions. Your role, is you work for an investment bank. You're underwriting a deal. What does that mean? How does a company hire your firm? Why do they hire your firm? And what is underwriting?
Yeah, sure. So starting with why a company would hire a firm, let's assume JP Morgan to lead their IPO, really it's usually the IPO advisory role is a role that has been built over time. It's very rare that a company will just come in, knock at the door of JP Morgan and say, would you lead my IPO? This is a long-term relationship, and this is a culmination of a long-term trusted relationship with a company, with a founder, with a CEO. Really, when the company chooses who is their lead bank, they're choosing a couple of things. One, they're choosing someone that has the expertise of taking a company public in their sector. So you've led deals in the sector that are relevant. You know the sector cold. You know who the investors are. Really, they're looking for someone that is going to give them the right advice, when to access the market, how to access the market, how to talk about the story, how to craft the story and go to investors. So all this is going to be very important. And the culmination of that is obviously the execution of the IPO. So choosing what is the price that goes on the cover, which city we're going to, which investors we're spending the time with, all the way to who are we going to allocate stock in that IPO and how does it trade in the aftermarket.
Yeah, and we're going to for sure come back to how you allocate stock in the IPO. But in that selection process, is it, quantitative or is it more vibes-based? Is a CEO and a CFO of a company saying like, I'm going to choose you because of your success on these 14 deals? Is it based on, the length of time you've been courting each other? Like in your mind, like what's the sort of deciding factor?
I think it's really both. But I would put an emphasis on the relationship first, because when you think about the IPO, it's one of the most important and critical step that a company will take in the entire life of its company. Taking a company public, sometimes we feel like it's really emotional, like it's the CEO, CFO work's life. Sweat, blood, tears come into this. You want to make sure that you have a partner on your side that is going to look for their best interests and not just doing a deal. But obviously, is your firm relevant in the sector? Have you led deals? It's 100% relevant because you just want to make sure that even if you love the bankers and you have a great relationship, if the distribution capabilities are not there, if the team overall or the quality of the bank underwriting is not there, you're not going to be able to lead that IPO. You're probably going to be part of what we call the syndicate, because usually you don't take someone public being only one bank. It's a broader syndicate of bank. But really the lead bank usually should combine both, the relationship and the experience.
Right. So let's say you're selected, a CEO and a CFO, and I assume their general counsel or whoever's in the room says, okay, it's going to be Alaoui, it's going to be JP Morgan, let's go. When they do that, what are they really getting out of the lead underwriter? Like, what are the different roles within the bank? What are the different like groups that come into the process?
Yeah. So what they're getting to that, and usually we use the jargon saying we're a lead left bank and
Yep.
stabilization agent. What you get is the entire power and force of the bank behind you when it comes to an IPO. It comes from at the very beginning, we're going to get our bankers sitting in a room drafting the registration statement, the S1 for most of the issuers, and really thinking about how do we sell that story, what is important, how do we make sure we make it clear and simple so it's easier to sell and it's going to garner a lot of demand. And then you have like other, I would say, part of JP Morgan that are involved. An important part is research. You're going to have research analysts that are going to be onboarded on the deal, spending time with the company, thinking about a model. After the IPO, they will be publishing a research report with a price target. So all this is also part of, when you're a lead bank, your analyst is also involved in the process. And last but not least, you have like everything around, the allocation, the trading. So we have all our sales and trading, the sales force picking up the phone, calling investors, selling the stock, the trading function, the stabilization agent, helping really in terms of thinking about the aftermarket performance of the stock. So all this is a pretty well-oiled machine, and there is actually like a lot of actors. Everyone has their own purpose and mission to be able to deliver a best-in-class IPO.
Yep. So you mentioned a stabilization function. What is that? And like what part of the bank is performing that role?
Yes. So that's part of the bank that is performing the role as a trading desk. Really what it means of being a stabilization agent is you're managing the greenshoe. So when we're pricing an IPO, we're pricing what we call a base deal. And there is, on top of this, a greenshoe component that could be up to 15% of the base deal. Really, what the stabilization agent does is, let's say we take public Robert LLC. We take it public.
I hope to take myself as an individual public one day. It hasn't been done before. There were Bowie bonds back in the day.
There is a beginning for everything.
Yeah.
So we take public Robert LLC. We take you public at $100 a share, and then the stock trades down for a reason. It may not be incumbent on the quality of the company. It could be the overall market backdrop.
I'm not going to trade down, but let's just say we
yes,
do.
Exactly. It's just assuming. The stabilization agent in that case will step into the market and really use the greenshoe, so those additional shares that they have at their disposal in order to buy really and support the stock, support the trading of the stock. So it's really a function that is here to think about it as an insurance policy. Like if the stock, for any reason, trades sideways, we are here, we can step in, we can support it. But if it doesn't, usually the greenshoe gets exercised, and that means more proceeds for the company.
Yep. Okay, so walk me through the mechanics of the greenshoe, because I think this is a really interesting concept that most people don't understand, because it's a pretty niche piece of knowledge. So what enables them to sort of buy low? So in the greenshoe, let's just say the IPO is for 1 million shares.
Yeah.
And the greenshoe is for 150,000 shares on top of that. Mm-hmm. Are they selling the greenshoe before the IPO and using the proceeds to buy back the shares, or how does it work?
Yeah. So how it works is on day one, when we're pricing the IPO and we're allocating the deal, we allocate the full deal size plus the greenshoe. Yep. So we're in some ways over allocating the IPO. And so when you're over allocating this IPO, you're in some ways creating a short position, if you will, for those 15% incremental shares that you have given to investors, but you don't really have them.
Right.
How do you cover your short? You have two ways to cover your short. Either the stock trades down, so you go in the market, you buy the shares, or the stock trades flat to IPO price or up. And in that case, the way you cover your short is the company issues 15% more shares to you, and that's how you close out your short position. So that's how it functions really in practice.
Yeah, so the bank providing the stabilization role is never economically at risk from that function because
Correct.
They know that there's the option for the shares backing it up.
Exactly.
Yeah.
Yes.
Is this the trading desk at the bank that performs this role?
Yes, it is.
Do they ever... And is this done in conjunction with the sort of underwriting side? Do they ever not sell the entire greenshoe? Do they ever, is there any reason not to sell the full amount?
So we always lay out the full greenshoe. There is situations where, for instance, some companies or some owners decide that they do not want a greenshoe because they're just like, we don't need the extra proceeds in case the greenshoe gets exercised. So we would rather keep it to the base deal. I would say this is the minority of deals. 90+% of deals have a greenshoe. And really, the main decision is we're looking at how the stock performs. If we feel that the stock is starting to get a little bit under pressure, we have 30 days to exercise the greenshoe. So we can take a decision on a daily basis. Do we want to exercise this, or do we want to keep the dry powder to support the stock? Sometimes the stock is trading well, but let's say right now we have geopolitical risk. There is a lot of volatility. You could make a conscious decision to keep the greenshoe open longer just in case. It's a balance. It's an art more than a science.
Yeah. So the greenshoe is kind of, it's allocated, when you're building the book.
Yeah.
And then there's post IPO activity to stabilize the price. Let's start at the earlier steps in the process, right?
Yes.
So you get hired. You're now on a deal. Right?
Yeah.
You're on the deal for Robert LLC, right? Where does this journey begin? We have the drafting of, the registration statements. When do we start marketing this to investors? And how do we start doing that? How do we syndicate this out to other investment banks to sell? How does the process work, for me, the CEO of Robert?
Yes. So first of all, an IPO process takes anywhere from 6 to 9 months from start to finish. So we really kick off the process literally with an organizational meeting where we get all the bankers, the lawyers, the auditors, the management team into a room, and we review what are we trying to achieve, what is the timeline, and what are the next steps. When you're thinking about the steps, as you said, one of the first step is putting together the registration statement. This is going to be the statement we're going to use with investors to sell the IPO. So it's literally we're sitting down writing it. We used to literally sit down physically and start like marking up.
You don't do that anymore?
We use Google Docs or any sort of other, more technology forward platform. So it's much better and it's making it more efficient. But think about the first 6 to 8 weeks are going to be writing the S1. Once you're done with that, you're filing it with the SEC, you're submitting it to the SEC, and then they're going to come back to you usually after 30 days. What you do while you wait for this, you have like different work stream. The investor work stream is one you alluded to. So you're going to start thinking about what are we going to tell investors? What are the materials we're going to use to tell the story? The reason why we start with the S1 is the deck we use with the investors, all the information needs to be in the S1. Then when we go speaking to investors, we do meetings that we call testing the waters, which really are meetings that it's like the name actually is pretty self-explanatory. We're going to see the investors to test the story and get the feedback. And then it becomes an iterative process. I want the investors to tell me what resonated, what did not resonate. Is there information that was really critically missing? Or do you love it and you're telling me like, hey, you need to bring this to the market because this is really what I want to invest in. So this is like a very interesting and iterative process. And usually you have multiple banks involved in that process. When you're thinking about lead banks, on average, it's 2 banks lead, sometimes 3, and it's a collaborative process. We share the accounts amongst the banks. Each bank books a number of meetings, collect the feedback, present it in a concerted way to the company. So I think it's one of the things that sometimes is underappreciated when you're thinking about IPOs, because you're thinking about Wall Street and you're like, oh, you guys are always fighting and you're competing. And like actually the IPO is a pretty collaborative process where we are all working towards the same goal and we're all working as the same team, as Robert LLC underwriter team.
Right. So when you're going through this testing of the waters, how quantitative versus qualitative is it, right? Like the feedback that you're getting, is it, specific, like I'm a mutual fund and I would pay, $42 a share? Or is it like, I like the company, but, here's some subjective opinions I have that I didn't like the CEO's hairstyle, or like, where does this testing the waters process fall?
Yeah, so it's interesting. I feel like the testing the waters process actually tend to skew positive most of the time. Because think about it. If you're an investor, you have there is no
there's-
upside.
There's like free call option value and like
Exactly.
being called back. To,
Exactly.
yeah.
So more and more, and as the testing the waters process has evolved, we're now basically in a situation where when we get the feedback, it's actually in an anonymized basis. If I think about, a decade ago when I started my career in ECM, we used to go and see 10 investors, and that was it. That was the testing the waters, and those 10 investors needed to be curated, chosen, and their feedback was critical. Now, if you're asking me the recent processes, let's use Circle as an example. We met hundreds of investors. So the feedback, to your point when you were asking qualitative versus quantitative, it's definitely both. The quality of the investors is very important over the quantity. But I would say the number of investors that we're meeting and the number of times we're meeting the investors has increased. I always like to quote a mutual fund who told me, I need to see the company before going on the IPO. If I just meet them at the roadshow, it's like getting married after the first date. No one does that. Well, now there are shows about people doing that, but
I love those shows. I watch them all on Netflix.
But everyone wants to make sure there are a couple of dates before you actually commit.
Yeah, that makes sense. So has it gone from like a sampling that's used to provide information to the bank to more of like a marketing function?
Exactly. Literally a more fulsome pre-marketing where you make sure that, hey, you can flesh out more of what really matters. Where do people need to be educated? Particularly when you're thinking about financial technology, digital assets, it's going to be critical because you're introducing new companies to the market. Sometimes those investors have actually never sat down thinking, what is a stablecoin?
Right.
Like, how does it work? And so you need to do that work, that pre-work, so that when you get to the roadshow, it's almost becoming a meet and greet, and investors are very comfortable with the management team and the story.
Yeah, that makes a lot of sense. And do you think it varies by the different groups within your bank, right? Is it like you have the hardest job because fintech evolves the fastest and like the manufacturing team is like, oh yeah, they don't need that much marketing. They just need to know like the multiples.
Yeah, please tell my boss I have the hardest job.
Yeah, it sounds like you do.
It's interesting. I would actually say that each subsector has their own idiosyncrasies, and each have, always changes and unique stories that they need to sell. So I think this is universal across the different sectors where you need to keep yourself up on your toes, be thoughtful, be creative on which investors you're going to and how you're presenting the story. It is true that when you're thinking about financial technology and digital asset, those companies are revolutionizing sometimes 100 years of, well-known industries. And you need to bring a new paradigm to investors saying, forget about everything you know and forget about, some of those incumbents or legacy companies, and think about what the future could be in financial services, in financial technology, in consumer finance, whatever that is, but really helping them think through like the extra step so they can understand what those companies do.
Well, how do you and your team and your group get up to speed on this, right? Is it proactive where you're like, okay, there's a lot of stuff happening in crypto. We need to learn about stable coins before you know that there's a Circle IPO? Or is it sort of like, in parallel where you're like, okay, we're talking to Circle, let's learn about stable coins? Like, how does that education happen internally?
Yeah, internally, it actually happens before we stepped in the Circle office, if you will. The reason why I say before is because if you want to be credible in front of a management team and say, hey, I actually know how to position your company and how to sell it to investors, you need to have the knowledge. We've been lucky enough at JP Morgan that we have created the Blockchain Center for Excellence like over a decade ago. So we have had a lot of people internally actually spending time on digital assets, on stablecoin, on all the initiative that came from the crypto sector, understanding, because we're a financial services company. This is, in some ways, could be a threat to our business. So we need to understand it, and we need to make sure to be at the forefront of the evolution.
Yep. Makes total sense. Okay, so you've gone through this testing the waters process, and you have essentially marketed, in a light way to a group of investors.
Yes.
People have gone on the first date. When is the formal, I don't know what you would call this, like the final date, right? What does the actual roadshow look like? Who's going on the roadshow? Walk me through it as though, it's Robert LLC. Like which members of my team are showing up? Which members of the bank are showing up?
Okay.
Is it in person? Is it via Zoom? How does a roadshow work?
Yeah, it's a great question. And I will caveat my answer that the roadshow, similar to what I was talking about on testing the waters, has actually evolved a lot, particularly post-COVID. Really now your roadshow is New York, Boston, Baltimore, if you want to go see T-Row, and then you can go on the West Coast as well, San Francisco, LA. But really the trifecta of New York, Boston, Baltimore ends up being the core of the in-person roadshow, and then you add virtual days. Like before, we used to go to Minneapolis and Chicago and, all those cities. We can still go if there is a lot of demand, but we have seen those roadshow work very well without having to go to that many cities in person.
Interesting. I'm surprised it wasn't inverted at some point where it's like you call up all of the investors and you say, come to the JP Morgan headquarters, on this day to meet with the team, for this IPO. I feel like you could easily centralize everything locally.
Yeah, you could, and we've tried. Don't worry. We've tried a lot of times.
Sure.
But I think that there is something to be said about the company making the effort to go see the investor.
Because that's the power dynamic, right? They're the ones who are deploying the capital.
Exactly. It's like, you want my money? And you show up to my office. And funny enough, like I had an investor, so I cover financial services, which is a pretty, I would say, traditional sector. And I had like a very high growth company that really had like a tech, bent. And the CEO refused to wear a suit. He was just like, I'm not wearing a suit.
It's a startup.
And literally the first, all the meetings I was going to, investors were like, you want my money? You wear a suit. And so it's interesting.
Did he wear a suit?
He was actually carrying with him a jacket just at the beginning of the meeting, and then he was removing it because I was just like, just wear the jacket. At some point, they care. I know it doesn't matter. It doesn't mean that what you're going to say is going to change. But if an investor, actually, they need to be good judge of character. At the end of the day, I'm investing in you, Robert.
Right.
Are you going to make the good decision when you need to make them? Are you going to take the pivot for your company when you need to make them? You can start with an amazing company, but if you're not actually taking the right decision at the right time, you're not going to be a good public company. So I'm buying you over the rest.
Totally agree. Was that in particular CEO's IPO successful?
Yes, it was.
And that's because he put on the jacket for the 30 seconds.
No, I think the company itself was really good. But it showed that he was very strong-minded. He had he knew what he wanted and he knew how to, drive his company. We work with amazing founders. This is what I love about my job is getting to know those founders, getting to understand how they got to the place they are. It's never an overnight success like you read in the press. It's a lot of work. So yeah, still was a good outcome.
Okay. So it's shifted from the private jet, meet everyone in person to a couple cities, New York,
Correct.
Boston, Baltimore.
Yes.
A lot of Zoom. Okay. So how long does the roadshow take? Are we talking 3 days? Is it 3 weeks? Does it vary by the company and the traction they're getting?
Yeah.
What's the process look like?
On average, 7 to 8 days. So you would start on a Monday. Usually you would start in New York. You would do what we call a Salesforce teach-in. So you go to the JP Morgan office. You're meeting with our Salesforce. You give them the pitch. You get them pumped up to pick up the phone, book the meetings. And then you're on the road really for 7 to 8 days in a row. So you start on Monday. You finish on the next Tuesday or Wednesday of the following week. Then you price the IPO that day and you ring the bell the day after. So that's really the from start to finish. So again, the first few days are going to be in person. Then usually we tend to have Friday be a virtual day because everyone needs to, unwind a little bit. But it's super intense. The companies met hundreds of investors in a short period of time. It's back-to-back meeting. It's sometimes group meetings, sometimes group lunches where you go to a fancy hotel in New York and you have 150 investors in a room and you're presenting the company. So that's a lot going on.
Yep. So let's say it's Monday after the very first day of the roadshow, right? The investors that the company has met with, are they submitting their indications of interest that night? Are they like saying like, oh, I'll think about it. I know I have another like 7 days of roadshow.
Yeah.
How's it work? Like, the CEO's met with somebody. What happens next?
So actually, some will. Some may, and even in sometimes we have investors that put orders before they meet with the company just to show the level of interest and the level of excitement they have in the story. Don't forget, most of those investors or some of those investors would have met the company as part of testing the waters.
Right.
So sometimes it's just a culmination of 3-4 meetings that they already had. And so that's why they're comfortable showing us an order on day one. Those day one orders are very important and critical because what we call the momentum in the book building is really important in terms of messaging how the IPO is going. I would say the majority of investors are going to take a little bit more time before showing their hands. We have investors that are notoriously known for taking a lot of time, and that's okay. Sometimes it's very high quality investors. They know that whether they come on day 2 or day 7, they're high quality investors, so they can afford, taking a little bit longer. And sometimes it's generally because they need time to put together the model. They need time to think about, is this the right value on the cover? Where do I care on this IPO? Am I okay through the range that is on the cover? Or do I need a little bit more concession or I have a little bit more flex outside that range?
So the investors that come in early and say like, you know what, I already met with you 2 times through testing the waters. It's day 1 of the roadshow. Here's my order. Do they get, metaphorically speaking, like rewarded for it? Or do they get like, more allocation, of what they asked for? Like, is there a benefit to them sort of objectively?
Yeah. So usually the underlying reason why they do that to convey their conviction, but also to make sure they're in good graces with the management, and that management will also help, not also management, but also the underwriter in getting them really like a nice allocation when it comes to like the last day of the roadshow. That being said, we also need to weigh it with the quality of the order, the investor, fact pattern. If this is an investor that is being known for taking an allocation and flipping it immediately, that's not in the best interest of the company. That's not in the best interest of the trading of the stock. So there is a little bit of, judgment that needs to be applied. It's not just as easy as you're first and your allocation is going to be greater. We basically apply multiple layers of selection.
Yep. Okay. Now I have a lot of questions.
Okay.
So when the order comes in,
yes,
right, what specifically is being expressed? Is it a number of shares at a specific price? Is it like multiple potential orders where it's like I would buy, 1,000 shares at this price and 12,000 shares at this other price? Like, how does the investor express their order?
Yeah. So it could be all of the above. So you will have some investors that come in and say, I want 5% or 10% of the deal, like my order size is 5-10% of the deal, and I don't have any price sensitivity within the range. So we call this an unlimited order. Then there are some investors that are more detailed that are going to tell you, okay, I want X number of shares at the midpoint, and I want X number of shares at the top end. As you can imagine, usually the number of shares decreases with the price.
Right.
And so it gives us like a little bit more detail as to what people care about and at what price. So when you get at the end of the roadshow, you're able to say, okay, we actually have a lot of demand through the range. No one has expressed explicitly a price sensitivity, so maybe we can move the range up. Or if we have a lot of people saying, I like it at the midpoint, but at the top end, it's starting to get very close to where I care, you need to take it into account as you're thinking about how to price the IPO.
So you get this bucket of orders. How are they synthesized, right? They're coming in all the way up until the end, probably,
Yes.
right? Are you using really big spreadsheets? Is there custom software to like synthesize all the orders? Is it the lead underwriter alone synthesizing all the orders? Is it all of the banks, in collaboration? Like, what's the process look like when you translate all of these orders that have come in? It sounds like some of them very, qualitative and some quantitative. Like, how do you synthesize it all?
Yes. So we literally have an internal system. That internal system is connected with other banks' system. So at any point of time, the lead bank controls the master order book. So anytime there is an order, it's in our order book. We see it in our system. And then we push the information also to the other lead bank on the syndicate so that everyone has the same information at the same time. Really, the idea is to say an investor, whether they call JP Morgan or banks XYZ, as long as you're in the syndicate, we'll take your order. So there isn't really a thing saying like, if you don't call JP Morgan, it's not going to be reflected. We are, again, in a collaborative way where we make sure everyone has the same information.
Who built this software? Is it like JP Morgan software, or
yes,
is it like,
it is.
So
okay. Each bank all built their own. And we've seen like multiple iteration of that software, trying to, improve it, add as much detail as we can. So literally we're going to have like, okay, if it's, investor A, who is the contact of the investors? Who is his sales coverage? What time did he give like the order? What was the size of the order? What was the limit prices on this order? Any additional feedback. It's a very detailed process. And then when we actually extract that information for the company, it's effectively a spreadsheet.
Yeah.
But from our perspective, it's internal software that we built.
Yeah. So we're now getting close to, let's say, the final night, right?
Yes.
The roadshow is done. You have all of the orders that have come in. Are the orders coming in to each investor's bank specifically? So like if I'm the mutual fund in Boston or whatever, am I sending my order to JP Morgan, or am I sending it to, Goldman? Am I sending it to multiple banks? Like, who do I communicate my order to?
So usually we would communicate it to the lead bank, but again, as long as you communicate it to a bank in the syndicate, it should make its way to JP Morgan.
Yep.
I think from an investor perspective, it's just more efficient to go to the lead banks rather than, another bank in the syndicate. So you make sure that there is no issue and your order is properly reflected. But the reality is you could go to any bank on the syndicate to place your order. Okay,
great. So now JP Morgan has all of the orders
yes.
that have come in from the entire syndicate. You have the spreadsheet, so to speak. Who is making the call at the end of the day on the final pricing, right? Like, is it the bank? Is it the bank like in deep consultation with the CEO? Is it a debate? Is it a recommendation? Like, what's it look like inside the bank when that like call is made on like what the final price is?
Yeah. So we effectively sit in a room and have what we call like a pricing call. And ultimately the company, the board are the ones taking the decision, because if I go back to Robert LLC, Robert is your company. My job as an underwriter is to give you the best advice. You may ask some question, if I price this IPO at this price, what does it do to the aftermarket? You may have different objective. You may say, hey, if the IPO goes up, 100% on the break, it's great. I'll be, happy. My employees will be happy, or I'll be very upset because I will feel like I left money on the table. Your podcast is called The Pop. It's really typical on the IPO, and that's where a lot of the IPO product debate came from. So we try to really design the process to make sure it fits your objective. But at the end of the day, you're deciding. We are making a recommendation based on our expertise, the information that we have at our disposal, but you're the one taking the decision.
Yep. I'm going to keep on pounding the drum on this very, basic concept in my head, trying to figure out, the process being qualitative or quantitative. But
yes.
like when you're making the recommendation on the number, like do you have like a sophisticated, model that you're using internally where you're like, okay, it takes all the orders in, it processes them, there's a little bit of logic on top, and it's like 27.5? Or is it like the good judgment of the people in the room that have done this 200 times, and you're like, all right, it feels like we should do top of the range, but not above the range and not below the top. Like, how does that recommendation come?
Yeah, sure. So there is a quantitative part where we literally, because we have people giving us orders with, price limit, we actually quantify how much demand we have, what we call the gross demand in the order books. We mean demand at any price. Then what is the demand at, call it $10, $11, $12 or above $12.
Yep.
And then we can actually, from a quantitative perspective, take a decision. The thing is, the qualitative overlay is the most important, because I could have, and you will see in the press, for instance, hearing, oh, this IPO was 20 times oversubscribed, or,
Is that always true, or is there a little bit of like hyperbole there?
It is always true.
Okay.
What is not being communicated in the press is what is the quality of the order book, because you can be 20 times oversubscribed, but if the quality of the orders you have in the order book are actually poor, I would rather be 5 times oversubscribed with very high quality and strong investor feedback versus 20 times.
Okay, so you've priced it. You've been on the phone with the CEO, and the board, and everyone agrees it's going to be $27.50,
Yeah.
right? How do the allocations work? So you've agreed on a price, you've agreed on the number of shares. Now you have all of these orders and all of these banks in the syndicate. How is it chopped up across the banks? How do you actually settle the book?
Yeah. So the lead bank is actually responsible for going through the allocation. And that's a very manual process. We literally go through line by line each investor. We usually go through what we call a mock allocation, a first cut, which we present to the management team in the company. We always ask the management team to provide us their feedback. So as you go through the IPO process, you're going to meet those investors multiple times. Tell us who made a good impression, who did not, who came prepared to the testing the waters, who did not, who was multitasking and answering text messages while you were talking, all these things that are, feedback that we want the management team to have, because this is a very important process. This is in some ways the most important part of the IPO, because you're really choosing who are the investors that are going to be with you for your life as a public company. Who are the top 10, 15 that are going to be out there pounding the table, defending the stock? Because I like to say, being a public company is not a sprint, it's a marathon, and it's a marathon with obstacle. There will be times where it's going to be hard to be a public company. Who is the investors, the incremental buyer that will come and pick up the stock when you need to? So that's why the allocation process is so important. So again, we go through each line by line. We assess the size of the order, the quality of the order, the holding horizon. Is this an investor that is known to hold for multiple year, or this is more like a quarter, or it's a quick flip as soon as the stock goes up in the aftermarket?
Yep, that makes sense. And I assume there's a lot of, orders that are aggregation, right? You might have retail orders coming from a Robinhood, right?
Mm-hmm.
How do you assess that? Because I'm sure there's it's 3x oversubscribed just from one investor. How do you, fit that into an actual book?
Yeah, it's interesting because this is when, your earlier question when you were asking me, is the sector fintech and digital asset different than the other sector? That's probably a sector where retail is actually treated and viewed very differently than in other sector. I would say retail overall has become a powerful force for the IPO market. The access to financial services, the access to investing in IPO has been tremendous for the IPO market and has really represented a new way to allocate the IPO and give stock to the retail investor. I know for a fact for every single company in the digital asset space, this is extremely important to make sure that the retail community is getting stock in an IPO. And some even founder and CEO consider retail as, at the same level as an institutional investor. We have started doing more retail-focused education, webinars to make sure that the retail individuals also can have the information that they require to participate, and really pushing the boundaries in terms of allocating retail. If I think about the deals I led, Bullish is a good example of a deal where it was extremely important for the management team and the founder to have higher allocation for retail, and we went all the way up to allocating 15% of the IPO to retail. Just to give you a sense, usually IPOs are 5 to 7% going to retail, maybe top 10%, and here we went all the way up to 15.
So the lead underwriter is the one that's basically putting together the final spreadsheet and handing it over to management.
Yes.
There's the first draft that you mentioned. How many drafts do you do? Right. It's all happening in one night. I mean,
Yeah.
walk me through like the hours of the day
Yeah.
and like where we're at now after you've done the first draft.
Yeah, it's interesting because it really depend on the management team. Have been in situation where we would do the first draft, we would sit down.
What time is it? Like, is it 6 p.m.? Is it like 4 p.m.?
It's 6 p.m. the first time we have the draft. Like usually we wait after market close a little bit to do like the pricing meeting. So the pricing meeting is at, call it 5:30, and then 6 p.m. we start having the allocation call. I'm making generalization. There is like situation where it's earlier or it's later, but I would say on average it's 6 p.m. You do the first turn with the company. There are some companies after first turn, they give you their feedback, they're done. They go, have their celebration party, preparing for ringing the bell the day after, and that's done. There are some management team that there will be a lot of iteration because they just want to make sure that you get, everyone's order into the order book. And there are some IPOs that are very highly sought after. And you're receiving so many, inbounds from investors, requests from people, and you want to make sure you're not missing anyone. Because again, it can be like it becomes a little bit emotional if, we miss someone or the company had a friend and family that showed up in the book and then, it came up in a different name and it was missed. So there is a lot of scrutiny to make sure that we're not making any errors.
At this point, within the allocations, the lead underwriter, how do you determine exactly how much of the allocation or distribution and fee sharing goes to each bank that's part of the syndicate?
Yeah.
Is that known ahead of time where it's like, hey, like, the lead is going to take 70% and the second is going to take like 14%? Like, is that known earlier? Is it known only after you've built the book? Like, how's that work?
It is usually known earlier. When you are mandated to be a lead bank, you're usually being told what is going to be your role: lead left, lead right, stabilization agent, etc. And then you're also being given an idea on the economics. It also can vary and move throughout the process. Let's say for a reason or another, a bank drops or gets added. So, you get an understanding at the beginning, higher level, and then it can move in the process. But you usually, by the time you price, what percentage of the econs you're getting.
Why would a management team drop a bank halfway through the process, right? Like, what causes that, right? Is it just like, they're not pulling their weight? Like, what is their weight to pull if it's not the lead underwriter?
Yeah.
Like are they actively involved in the roadshow and they book the private jet to the wrong destination or something? like what would cause a bank to be removed halfway?
So I would say the most time that I see in a bank, lower in the syndicate, because a lead bank being removed is pretty rare.
Yeah,
because again, it doesn't send a great message to the market, and you need really to have like a big screw up for this to happen. So it doesn't happen ever, really.
Yeah. So this is all interesting. Let's say we're now done the model, right?
Mm-hmm.
It's 3 a.m. The allocations get sent out.
Yeah.
The lead right bank and, everyone on down is like, are they emailing their clients at that point? Like once the model has been like stamped?
So when you say emailing their client.
Yeah. Like once the allocations are decided, right?
Yeah.
You've gone through the spreadsheet and management has signed off on it. What happens next?
So literally what happens next, the company has signed off on the allocation. We all go to bed. We come early in the morning, and we have the entire morning for, call it 7 a.m. to 9 a.m., 9:30 before the market open, to have our sales force pick up the phone and tell the investors how much stock they got. So it's literally calling again one by one all those investors and confirming the order. So mutual fund A, you ask for 100,000 shares. Here is like 80,000 shares, and the settlement date is X. So that's what we do in the entire morning. Then what is very important is also once the market open, and this is going to be the work that the stabilization agent is going to do, is deciding where to open the stock. And literally, this is like, a function on the trading desk where you're going to have like our lead trader for stabilization agent looking at the order book, working with our syndicate desk, working with me on the capital markets side, asking for feedback. So who was very bullish on the IPO, who has room to add, to really have like the tension, offer and demand tension to find out like what is the right price at which to open the IPO.
Yep. Are they looking at, the actual exchange order books, to make that decision? Like how much information do they have at this point?
So they're in constant contact with the exchange. They're sitting on the trading floor at JP Morgan, but they have like direct connection with either the New York Stock Exchange or the NASDAQ, depending on what the company has decided, where the company has decided to trade. And then really they have all that information so they can see the order book from them. And they also can talk to our sales force and try to either source order, source demand, supply in order to find like the right level at which they open the stock.
Yep. And then the stock opens and hopefully the stock has popped from the IPO price and everyone feels incredibly good.
Yeah.
And trading commences.
Yes, exactly. One of the staple obviously is the companies go to the exchange to ring the bell. It's always like a very exciting and emotional time where you have like literally all the companies, their family, etc., gathering, and that's a culmination of a pretty long process. And then yes, the stock trades during the day. We are updating the company and the management team on any sort of flows that come to our desk. And then every single night after, the first night, we have a call with our stabilization agent trader talking about what are the flows that we have seen, how is the stock behaving, and also talking about should we exercise the greenshoe. So it's not over as soon as we start trading. There is still a lot more work to do.
How many times have you as the investment banker been on stage when they ring the bell?
So I think probably dozens of times in NASDAQ and never at the New York Stock Exchange.
Never? They don't invite the bankers to the New York Stock Exchange?
At New York Stock Exchange, and to be precise, when I say on stage at the New York Stock Exchange, I mean the balcony.
Yeah.
The balcony can only hold 15 people. And so in the pecking order, the investment banker is probably not like on the list of 15.
CEO, CFO,
I like to think very highly of myself,
yeah.
but there are more important people that needs to be on the balcony that actually contributed to this company. So I would not impose myself to the balcony. I've been at the bottom of the balcony, cheering for the company and screaming, being very excited, but not on the balcony.
They have to build a bigger balcony.
Yeah.
That way you can fit the bankers in and everybody's happy.
I know. Like if you're looking, for example, at the NASDAQ, you can fit, I think, 70 plus people on the floor. So that's why, yes, then the bankers can make the cut.
Yeah. Alaoui, do you have any final thoughts on the IPO process that you think, people would benefit learning from? From your, long career in investment banking, what don't people know? What should they know?
Yeah. So one of my mentor, Liz Myers, who was a veteran in capital markets, and she's been like a great advice in my career. I love that she always said, the IPO is just a picture. It's not the full movie. And I think that's the one thing that we want to make sure the founders and the management team understands is getting the IPO right and the right price and the right aftermarket performance is very important. But then it's just the start of a long journey as being a public company. And we want to be part of that journey. It's not like, it's price. I cheered at the stock exchange and my mission is done. I actually want to make sure that the stock trades well, that every single quarter after the IPO, the companies perform well, so the investors are happy with their investment. And I often say investors are not going to remember where you priced the IPO, but they remember how you made them feel. And you want to make sure that they feel really good when they're thinking about your company.
Alaoui, thank you.
Of course. Thank you, Robert.